snap. What's up, everybody? Michael Silva here. Guess what? The signal is back again. What signal am I talking about? We're going to discuss that on today's stock market brief. And no, that doesn't mean the market's going to crash. What we're doing today is demonstrating what the signal has looked like in the past and what kind of opportunities may come out of it. That's the important part. So I'm going to give you an inside sneak peek into some of the trade ideas that I'm scoping out for potential safety if the market does want to start rolling itself over. That's what we're going to talk about and more on today's market brief. If you're new here, welcome to the show. We use technical analysis, intermarket analysis to get a good idea as to where the market might be heading next. Hit that thumbs up if you haven't done so already, and make sure to subscribe to the channel. We do Monday through Friday. And if you're on Twitter, hit that like and retweet it. It's greatly appreciated. Let's get into today's episode. So what are these lines on the screen? These arrows on the screen, on the SPY? Well, it has to do with the Fear and Greed Index. And we are approaching the extreme greed level. Now, if I take a look at the timeline of this, you'll see dates where we reached into extreme greed, extreme greed, extreme greed, extreme fear, extreme fear. So what does that look like on the map is this, right? This is where we reach those extreme levels, and we've seen the market, while it's in extreme fear or extreme greed, it's a contra type indicator where we get the opposite move. While everyone's fearing, we move up. When everyone is super greedy, we move down, and so forth down the screen. Now, I'm showing you this because if you overlay the relative strength line between the SPY and consumer staples, you find something quite interesting. Now, consumer staples, utilities, sometimes healthcare, these are considered more risk-off type sectors. So all I did was overlay the relative strength line, and as you can see, when we are in extreme fear, the market moves up, and what does the blue line do? It just kind of goes to the side, chopping back and forth. Now, when we reach into extreme greed, the market goes down, but what do you see the blue line do? The blue line shoots up, okay? Now, what do you see here? Okay, more extreme greed, marked the bottom in this relative strength line, and we started to go up. Then we got extreme fear, boom, market went up. This line goes down. So it works, kind of contradicts one another. So as we're approaching the new signal, right, we're getting extreme greed again up in this range. Is that telling us that potentially here in the near future, we may get a rotation back into consumer staples where from a relative standpoint, remember, relative is not absolute, right? If the market falls on its face and brings down everything with it, consumer staples may fall less because it's a risk-off asset. So we're going to show some setups that are low risk from an absolute perspective and so forth. Now, if we take a look at today's performance, consumer discretionary, which is one that we like to look at relative strength lines between consumer discretionary and consumer staples. So they were both up there in the leaderboard today in the top 3 of the 11 sectors. Interesting type price action. Now, if you don't know why we do the relative strength line between these two, it's because consumer discretionary is more like, hey, these are the wants, and then you do it versus the needs, the necessities, is what's considered consumer staples, and why it's more of a risk-off sector. If you take a look at the heat map today, well, the big leader there was Tesla, and Tesla is doing big things in the after hours, so keep that in mind when I show you, coming up, the relative strength line. Okay. Now, we also know that the bullish percent index for the NASDAQ composite is reaching into oversold territories, according to the RSI. Remember, overbought can stay overbought for a while. It's done that before. I like to wait for negative divergences to form, but you never know. We might not get it, but it is in that overbought condition as big tech names have been kind of taking the lead there. Now, if I show you the relative strength line between consumer discretionary and consumer staples, this basically means one thing, okay? When the line goes up, consumer discretionary is outperforming consumer staples. When line go down, consumer staples are doing better than consumer discretionary. So when it goes down, it's more risk off. When it goes up, it's more risk on. What do you see this line doing, right? We had this big move off of 2023, no surprise there. We flagged, and we're doing a full measured move on a relative strength line right there. Now, I have some other lines on the screen. Now, like I said, Tesla in the after hours is flying off like a rocket ship, and I had to redraw this, channel. You can draw it a bunch of ways. You can draw it. This is Tesla, by the way, down like this. You can do it like that. You can do it however you want. But then I found out, I was like, yeah, I'll connect this. It had a little bit of price action there. It connects here. Then it all connects. So I was like, that looks good. So after hours, it is coming up into this upper portion of the channel, and it's also above its all-time high anchored volume weighted average price. Okay, so that means what? It means that this can potentially still go up higher and open up higher tomorrow. Now, I want to call out a couple of things, the lines on the screen. Okay, so when we get very extended in the RSI, this is an 80 reading or above. Okay, that's what the pink boxes are highlighting. The pink boxes are highlighting when the RSI on the relative strength line reaches 80 and above. And you could see it can stay up there for a while, a month, and then boom, we kind of we went back to we just went back down, right? So when we get really extended, things take a breather. When we get extended, are we going to see a potential breather in the near future? The next thing that I did was just a rate of change, 12-day standard rate of change, and then I put it at, I believe, 10 or 11%. So basically, when we see a big move up 11% on the relative strength line, what happens when we start falling down back through the 5% down towards zero? Well, you can see right here that happened, and that marked kind of that top. So not only did we get the RSI getting overextended and a high rate of change, but then the rate of change started coming off, giving us more clear indication that it can head lower. Same with right here, we started to head lower. And then you could see other times like right here, and right here, where we actually went lower as well. So not only is it pretty frothy RSI, it's also a pretty frothy rate of change. And these type of rate of changes, if you just look through history, they don't stay at that type of rate of change every 12 days. They need to consolidate, they need to pull back, and so forth. That does not mean crash. That means to digest its recent big run up. Remember, strong moves in rate of change can lead everything higher too as well. It's a breadth thrust, all right? But I'm just calling out a few things that I'm noticing here, what is the conclusion of this? It means if this does digest or come down, that means consumer staples is going to be outperforming something that's been doing good all year. And we have that obviously signal from the fear and greed perspective as well. Let's take it another step further. Okay, let's take a look at the advanced decline line for consumer discretionary. So this right here is the consumer discretionary chart. It looks good, right? We came up to it, we consolidated, boom, tightened up, boom, we blasted off like a rocket ship. What is the cumulative line telling us? Well, as we reach a high here, that was right here, the price action in the advanced decline cumulative line is telling us that, hey, the price is going up, but there's not that many leaders really taking it up with it. So it's not confirming, creating a negative divergence here, which could potentially lead to this pulling back or digesting at some point. And it could also correct, don't get me wrong there. On the flip side of that, if we look at consumer staples cumulative line, you actually have a low and a higher low, and then you have matching lows right here. So as price is consolidating sideways in consumer staples, the internals are strengthening there slightly, giving us a potential indication that this is building a base. Now we need confirmation, but it could very well potentially move higher. Now, if we look at the top 9 holdings of consumer staples, this is the list. You got Procter & Gamble, PepsiCo, Coca-Cola, Costco, Walmart, Mondelez, Philip Morris, and so forth down the list. If I take a look just at consumer staples, you have the MACD starting to flatten out. You have the histogram starting to put in a bullish divergence on the histogram. So that's a positive thing. You're getting a positive divergence in the RSI, and then the relative strength line looks like complete garbage. Don't get me wrong, this thing can turn right back around, but or it can continue to head down, obviously, as it were just fluctuating right now by the 200-day moving average. So we're going to get into some of the trade ideas from and in the consumer staples section. Before I do, I will bring up my swing trade platform that I offer. It's $9 a month. It's Patreon. Once you sign up with Patreon, they handle all the billing and all that good stuff. All you have to do is sync Discord up to Patreon, and then you get access to the community, and then you get access to more trade ideas that are more broader than just consumer staples. I'll do watch list updates. I'll give like my watch list. monthly expected moves, quarterly expected moves, weekly and daily, which are some of the things that I love to use. I put out the zones in there too as well, which is a large document. Just to give a broad overview of things in the market from an intermarket perspective that are overbought and oversold. And then if you like my charts that I share with you, I post them here in the stock market indicators section as well. If you don't want to pay $9 a month, I don't blame you. I don't like having monthly things come up at me. You can do annual and get a 16% discount. But I do so much data on here for the cost. I do not offer refunds on the $90. So if you want to try it out for $9 and then switch it if you absolutely want to check it out. Okay, we're hopping into it. PepsiCo. Okay. Oh, and you know what? Before I actually get into it, just so you know, this is not an alert service. I'm not sitting here to walk you through alerts. Okay, that is not what I do here at all. These are just things that are on my watch list on my screen, and then I share them. Very similar to what I'm doing now. Okay, PepsiCo. All right, so this is one that I put on Twitter. We have that positive divergence in the RSI. We had a bullish engulfing candle today, and it's pulling back into a prior area of resistance. And resistance, once broken, can potentially become a level of support. Now, keep in mind, we're below a 50-day, below a 20-day declining moving average. So it'd be better to see price actually get back up through this level. However, if we do see consumer staples start to pick up pace, I feel like we can go retest that 50-day and potentially break through it. Also, the MACD has not fully curled over yet, but the histogram is showing a positive divergence. So that's looking good as of right now. Just be aware that if we start getting under 180, that opens the door lower to the 200-day moving average. Let's look at Mondelez. So Mondelez, I think I'm pronouncing that correctly, does have a positive divergence in the RSI as well. This is below a declining 20-day moving average, okay? So that can act as overhead resistance. And it's also below the 50-day, which is inclining at this particular point in time. You have a positive divergence on the histogram of the MACD, and the MACD is not curling fully over yet as it stands, with the bullish engulfing, which is a potential 2-day reversal pattern. You just need follow through with it. Overall, the price action, it's in a wedging formation, right? We expanded and now we are contracting, getting tighter. So if we start breaking below this 72, 71 area, then I'd say proceed with caution, because that opens the door as low to, to around 67, or potentially even that 70 area where we had prior area support there as well. However, it has been in a nice uptrend. It's just really digesting its recent run up. So it's not one to just skip over. I think that there's some opportunity here. It has a decent yield there as well. Okay, so that's that one. Here's Alitalia, or ticker symbol MO. This is a tobacco company within consumer staples. Now, this is like, I kind of like these type of setups a little bit more, and I'll tell you why. First, well, holy moly. First, look at this yield. That's 8.2%. Pretty wild, actually. That's a high yield. So first, you could really see the expansion and contraction. But what I like here is price is getting very tight. So 1, 2, 3, 4, 5 days of tight price action, just under 45.50. Okay, and it's back above the 20-day. It's rather just in a sideways trend right now. Okay, so you gotta just consider that to be like, it's neutral, right? So we can come up and break right back down. We'd just still be in an overall chop box. However, price action is getting very tight, and that offers a very good risk to reward setup. So if we break out of 45.50, yeah, I can just have a stop below this daily candle. If you want to give it more room, just make sure you, control how much your position size is. Okay, so if you want to say, I'll go long and I'll just have a stop under here, okay, well, make sure you're positioned to take a loss of, plus $2 per share to potentially earn, maybe potentially go swing back up here, so that would be your reward, and then your risk would be right here. So just above a 1-for-1 right there. If you wanted to shorten out the risk there and then make it here, or potentially you think it's going to go touch higher, then you can see obviously smaller risk versus the larger reward. You also have a positive bullish crossover there in the MACD. So that's a good looking chart overall, just very neutral price action. I just like how it's coiling up. And that means to me that price will probably expand here in the near future. And that could be to the downside. We don't know, okay? That's not what we're trying to do here. Clorox is another consumer staple. It's just been getting beat up, right? You can see this one actually pulled back into the 50-day and declining 20-day, and it got rejected, okay? So that's something to think about, right? On the other charts I showed you, they haven't reconnected it, but this is could very well happen. Now you see price action starting to coil up here. You had an inside trading day. You do have a positive divergence there in the histogram, but we still don't have a bullish crossover as of yet, and it's just within this downward sloping channel. We saw a nice move up. Now it's kind of taking a little bit of a breather. If we start getting back above this 162.50, this could very well open the door to start moving back to retest these highs over here. It's typically said strong stocks typically get stronger, and as it stands right now, the 200 days starting to slope up. We're back below the 50, so you want to get back above that in theory. However, I know people that like to get in early, and you can look at this and you can be like, well, technically, all right, let me redraw that. Technically, we're just kind of, right where prior resistance was in all this volume, and now we're holding above this area. So if I want to go long here, and then I'll just have a stop, under 152 or just under this, if it starts breaking down, I'll just get out of the position and then wait for it to set up. That's totally reasonable, because you'd be taking on smaller amount of risk if you get stopped out, which is more likely to get stopped out in those situations. From my experience, you take on smaller amount of risk, but if we start breaking out to the upside, you can see the risk versus that reward is significantly different. If you take a look at Costco, was once bearish looking, now is above all those key moving averages on the earnings on that big volume. And we're breaking from that downward sloping trend line. Price action's coiling up here, getting pretty tight. I would, if you buy in and you just trade under the 20-day moving average, it's getting a little extended, so I don't like to chase up here. I would prefer to see something happen or pull back, but it looks like it has a clear shot to 530, which was this prior area of resistance there. The next one is Walmart. Now Walmart, I would also like to see price tighten up a little bit more right under this 152.50, but you can see here price cupped, kind of handling out right here. Could be a cup with handle, and it's right next to this prior pivot area. So like I said, I would prefer to see price action coil up a little bit tighter, and then the moving averages to catch up a little bit more, and then potentially play a breakout of that pivot. But a good looking chart as it stands at this current moment. All right, the last thing I want to just touch on there is the SP 500. We're still within that bullish consolidation. Yes, it's getting to extreme greed, but that does not mean the market can't go higher, okay? Remember, we had extreme greed actually right here on this day, and then it popped up higher before actually marking a top. That was the most recent extreme greed signal, okay? If I reiterate once again this area right here we talked 2 videos ago, where it was like, hey, if you buy in now, it looks like you can tag it about a $3 plus per share gain. Well, we're not too far off of it, as we're just consolidating right around the all-time, or the 2023 all-time high. You can see volume kind of is depleting here. It's drying up. The red day had more volume, so that acts as a period of distribution. To remember, as volume dries up, if we do get a breakout, it is nice to see breakouts on bigger volume to confirm a solid breakout, right? That's positive. It doesn't necessarily need volume to go up and higher every single time, but just notice that, hey, if volume is higher tomorrow and we get an up day, that's not a bad sign right there. However, if we get a red day and volume's higher than the day prior, well, those are counting as distribution, and that's not always a positive sign. If we take a look here, the SPY 15-minute time frame, I have that white line that was going across the August high right here next to what? That's the upper daily expected move going into tomorrow. That's 431.53. You can see we kind of ran into resistance up in this area. We came down to the 5-day moving average, got just below it. But guess what? The month to date, which we were discussing yesterday, held as a level of support, and we started moving up higher. We broke through the week to date, we back tested the week to date, and we continued on. So we have a pretty open, door come tomorrow. And even more to note is that we haven't touched the weekly expected move yet, and there is a lot of room to make a big day on a Friday. Fridays are typically called VIX Crush Fridays. We'll see. I don't make bets based on that, but you never know. Now, if we start breaking through the highs over here, that opens the door to go up here and touch this August high. If we start breaking down, just understand that we're still above a month to date. We're still above a 5-day moving average and the week to date as it stands. Watch that 426.73 if we start to get some sell side activity into that level. See if price bases around and starts to break higher from that. We do have a subtle negative divergence on the RSI, as there's a high, higher high, high, lower high right there. So price may need to consolidate, but that's okay. It's been doing that for multiple days. That's all I got for you, everybody. See you later.